how does the Fed control the job market? Since like the Fed only has a limited amount of tools, so how do they specifically like slow the demand for jobs?
Yeah, I mean, let's review what those tools are, first of all. And there's lots of little ones, but the three biggies that come to mind that I think are important. Number one, the Fed talks about raising interest rates, which is what they've done first. That was the first thing they did. They started that in November, and they really aggressively talked, and so it got more aggressive from November through, really now, about raising interest rates, fighting inflation, slowing down the economy. They say the words that scare the stock market, but certainly, but they also say the words that make the bond market react. And so now all of a sudden, mortgage rates went from below 3% to above 5%. Housing is a huge component of the economy. So, if you slow down housing, right, there's a bunch of jobs that might not be open anymore because new people, in construction aren't adding, new people. So that talk is first. The second, thing that they really have done here is to raise rates. And this is their standard scenario. Rates were basically at 0%. And now they've raised them up, twice, 0.25%, and now, 0.5% in this last meeting. And obviously, when you raise rates, it makes borrowing costs higher. And interestingly enough, there's probably a psychological component of that also, just because businesses look at that and say, wow, here's the trend. Things are going to be going up here in terms of rates. When they've done that in the past, the economy does slow down. So if I'm a business person thinking about future investment, I might buy this big machine. Maybe I won't until I see how things play out here, because if the economy cuts down, I'm going to end up with this big machine or whatever it is, or these people that I'm hiring, right? And so maybe I won't hire as many people right now because I'm not sure about the future, yeah? And then the other thing that they're doing, and this one's actually kind of interesting, and that's, of course, letting bonds fall off of their balance sheet, or actually selling some of those bonds. And it's what's called quantitative tightening. So quantitative easing is when they were buying those bonds, and now quantitative tightening, they're letting them go. And it's a little bit controversial as to what that really means. How much impact does that have? We have great data on raising interest rates, definitely going back forever. Quantitative easing and tightening has really started with the 2008 downturn. So we've only had a little while to really see how that plays out. But that would be another thing that they're using. All of these, in essence, are trying to slow down the economy and make businesses think about not putting up new jobs, in essence, because they're just nervous about what the demand will be for their products, going forward. So.
Yeah, but those still seem quite blunt. It's not very targeted. It seems it kind of hits everything, but not really specifies.
Yeah, exactly. So, if you're in a business that isn't really hiring, and you're still going to get whacked on the head and slowed down, because maybe you're already kind of slow, and that you're going to be even slower theoretically as they go through this process. Yeah, they don't have kind of surgical techniques to come into certain industries and deal with it. And some job openings are open because there's nobody to take those jobs. We don't have enough Americans that are trained in that particular area. And even if you try to slow down the economy, there's still so much demand for those people because there's nobody here to do it. I know that used to be true with software engineering for a long time. I don't know if that's true now or not, but nonetheless, so that's why you're exactly right. It's sort of this blunt thing. It's a big sledgehammer. It hits all businesses, whether they're going fast or going slow. And so it can be, it's something to pay attention to when they start to raise rates. We are in the infancy, though. We're just beginning. So you got to be careful with being too forward thinking as to what might happen. But that's the Fed's methodology, and they did speak about that a lot. They talked about getting job listings down as a good thing. Obviously, usually you want those job listings. That's what in a recession you want more job listings. But then everything has a too good and too bad scenario. You want this kind of middle ground, and so. Right now, there's too many job listings, and that's going to create this wage inflation spiral that they're worried about. So, yeah, it's good. It's a good question.